In the world of Forex, understanding the state of your trading account is essential for making smart decisions and maintaining control over your trades. One of the most important concepts to achieve this is equity, a term that often creates confusion, but is fundamental for any trader, whether beginner or experienced. What is equity, and why is it so crucial? Let's dive into it. Equity in Forex refers to the total value of your trading account at any given moment. It's the combination of your current account balance plus the unrealized profits or losses from your open positions. If you have active trades in the market, your equity will fluctuate constantly as prices move. This is why equity is considered the real-time representation of your account's value. Imagine you have a balance of $5,000 in your account and open a trade that is currently showing a floating profit of $500. In this case, your equity would be $5,500. Conversely, if that same trade shows a loss of $200, your equity would drop to $4,800. This makes equity a dynamic indicator that reflects how your trading activities are impacting your funds. Why is monitoring equity so important? Because it's directly tied to your account's ability to withstand losses and keep trades open. If your equity drops below a critical level, you could face a margin call or even have your positions automatically closed by your broker. For this reason, equity is a key metric for assessing the health of your account and managing your risks effectively. Another important aspect of equity is its interaction with free margin, which is the money available to open new trades. Free margin is calculated by subtracting used margin from your equity. If your equity is low due to floating losses, your free margin will also be reduced, limiting your ability to take advantage of new market opportunities. Monitoring equity also helps you make informed decisions about when to close trades. If your open positions are generating significant profits and increasing your equity, you might decide to close them to secure those gains. On the other hand, if your losses are severely impacting your equity, it could be a signal to adjust your strategy or exit the market before things worsen. Managing equity is a combination of discipline and planning. Setting stop-loss orders, trading with appropriate lot sizes, and avoiding over-leveraging are essential practices to protect your equity and maintain a healthy account. Additionally, consistently tracking your equity allows you to assess the impact of your trading decisions and make adjustments as needed. In conclusion, equity is far more than just a number on your trading platform. It's a fundamental tool that reflects the true state of your account and helps you manage risks, evaluate opportunities, and make informed decisions. By understanding and managing your equity effectively, you're setting yourself up for a more sustainable and successful career in Forex trading.